Before we dive in, quick shout out to the BDO Retreat. If you're a top producing SBA lender looking to level up your game, connect with like-minded pros, and walk away with fresh strategies that you can actually use, this event is for you. We're talking workshops led by some of the greatest BDOs to ever do it, exclusive networking, and a chance to recharge your batteries after another year of grinding it out. It's happening January 16th and 17th in Key Largo, Florida, and spots are limited. We only have 20 seats. Go to artofsba.com to learn more and reserve your spot today. Now on with the show. This week on the Art of SBA Lending.
I think people care more about the personal brand of who they're working with than they do the bank brand.
Can I ask you a silly question?
Yes.
What's the BDO do then?
All right, let's do it. Let's fight.
Okay.
I think we wouldn't have ended up with some of the recent changes that we just got if there were better understanding from people who are on the front lines with the customers to the SBA policymakers.
Then maybe you shouldn't be doing this.
All right.
I once had a boss that told me, if you bring me a problem, you better bring me a solution. Well, the problem is that taking titled vehicles as collateral can be very cumbersome. And the solution is CorpSmart. When you have a loan involving titled vehicles, CorpSmart is there to handle everything, from transferring the registration to taking title to making sure that the sales tax is paid. I've got to be honest, I didn't even realize sales tax was a thing until just a few years ago when my borrower called me from the closing table because he got hit with a $50,000 bill at closing that I didn't account for in my structure. And so in the spirit of solutions, CorpSmart has an offer just for Art of SBA listeners. Now you can quickly and easily request a DMV quote directly from the CorpSmart website so that you can accurately account for all of your closing costs and properly structure your loans upfront. Just go to corp-smart.com/Art of SBA. We'll leave a link down below.
I'm gonna get myself in trouble on this one, but I was doing my research and I looked at your LinkedIn and I scrolled and I had to keep scrolling to get to the bottom. You guys' business the year I was born. I had no idea.
Time goes quickly.
We got to start there. So like, cause I guess I knew Lisa just from deal trading a long time ago. I just heard someone out west that could do business acquisitions back when I was like, no one could do business acquisitions.
Right. There was a time.
Like I couldn't do an airball over like 500K.
Nope.
And then when you guys started working together, which you had worked together before.
We worked together for Live Oak was our third bank together. So,
amazing.
Yeah.
So I was like, okay, so you guys are like kind of like BDOs kind of running this program but you had run shops. You had done a lot of different things.
I had basically spent my entire career managing SBA departments. And I was frustrated because I had started the strategy of going after just business acquisitions primarily with Lisa and was trying to hire other BDOs. Lisa got it. That's why we kind of got together on that whole concept. And I was trying to bring other salespeople into the fold of that strategy. And they just wouldn't change what they were doing. They were comfortable, especially in the West Coast here, doing real estate, commercial real estate. They're big loans.
Give me a gas station at 115.
They're easy. They're sort of cookie cutter to underwrite. They're not as tricky. And so my frustration was that I couldn't get anybody to dive in on the strategy, even when they would say they would. So when I went to Live Oak, it was the opportunity to no longer have to manage a back office. I didn't have to set up a department. I could just go in. Live Oak had the back office bigger than anyone. So I had no worries there. I could just go in and focus on the sales strategy, which is what I wanted to do.
Right.
And so it was kind of funny because I think Lisa at the time thought it was going to be a shock to me to be a BDO. And I said, no, this is going to be so much easier. I'm excited. And it was. And frankly, it was so much easier. But by then I had a strategy and I just wanted to free myself of all those other duties and burdens, so to speak, and just focus on the strategy of business acquisition lending. And our strategy was a little different at the time, and still a lot of people do this. Everyone was, especially at Live Oak, was developing that kind of business from business brokers.
Right.
And we decided we did not like that. There's a lot of reasons why I still don't like that. It's a
Conflict.
conflict of interest. This, in no other part of M&A, no other layer of M&A in the market would a buyer be getting instructed which bank to go to by the sell side. It doesn't make any
Well, and
sense.
also the buyers can't get representation because they don't do splits. They do in Florida.
Yeah, that's true, right? Florida does have a unique, right? You don't really have buy side representation, is what you're saying. There's
Right.
there's some that are trying out there to develop a buy side, broker model, but it's expensive, it's risky, so it's never really taken off. So you're right. Most of the time, the only broker in the deal is for the seller. They're getting paid by the seller if the deal closes. So they are focused on closing at all costs in some cases because they're not at risk on a loan, or they're not putting their personal guarantee on there. So that conflict appears in a lot of different ways. Even for the good brokers who maybe sometimes don't think they have the conflict, it's still there. They're still representing their client, trying to get a deal closed. And where I see the biggest problems taking place, and it still happens every day, is the bank feels like they got the deal, the lead from the broker. They have a question about the business, and instead of asking the buyer, who they should be filtering all their questions through, because the buyer better know these answers. If they should
Right.
they should be exploring all this and getting the answers themselves. They're asking the broker. And the broker's going to, even if they don't intend to, they are going to sugarcoat the answer because they just want to get it through. They want to get the loan
answer's
done.
wrong.
Or the answer wrong.
I
Yeah.
couldn't tell you how many times the answer's just been wrong.
Yeah.
And it's written back in a definitive manner, and then I just find out it's wrong.
Yeah.
It's like, okay, what's right then?
Right. They don't run the business. They're the broker anyway. But so yes, I think that any bank or lender that filters their questions in a business acquisition loan through the seller's broker, or even the seller directly without the buyer being part of that conversation, is making a big mistake.
Yeah.
Yeah.
Yeah. Because the thing with the business acquisitions, it's especially the big ones,
Mhm.
if it does go bad, this is why they don't like them, a lot of them. If it does go bad, you get a big hit, big loss.
Yes. And in banking terms, it's probability of default, PD, is, the likelihood of default. It's actually the lower PD between, if you look at the default rates of SBA loans and you break them out by acquisition loans, existing businesses, and startups, the one with the lowest default rate, so the lowest PD, is actually acquisition loans, not even existing businesses. And I have that posted on my Twitter.
Well, but that is the whole 7A. So that probably, is that measuring units or volume?
I believe it's dollars.
Because it's probably the small loans is probably what's driving that.
I don't know, but it makes sense to me that the acquisition loans would perform better because they're longer.
Really?
They're businesses that have been put through so many filters for a buyer to even want to buy it, and then a lender to want to lend to a change of ownership situation.
Yeah,
So
but then you're putting all this debt on. Like, I would think existing would be the best. Like,
you would think so. I think
existing.
initially most people would think that. I just, from having been in this space as long as I have, it doesn't surprise me that it's acquisitions that have the lowest. But I think it surprises most people when they look at that data.
Yeah. I mean, I've seen the chart, and it's all around, it's all relatively low, I think, default.
But to your point, probability of default is low. It needs to be, because loss given default, which is how much you would charge off if it does go bad, is very high because there's no collateral.
I feel like I used to do business when you were doing these before, maybe in the lead up to 2020, like the 2010s and stuff. I thought like it was so hard to get these done, and that it was only you, Lisa, and Bruce Marks doing them. and Bruce would always be like, yeah, I'm at prime 275. Like, I don't budge and I don't pay brokers.
Yep.
Now deals are getting done at rates that you would think are like real estate rates. When did that change?
Yeah, I think you're right. Around 2020 is when more banks decided that this was an okay space to lend in, and they started dipping their toe in, and some banks got better and better. So you had more banks competing. And once you have more competition, you're going to have lower pricing. And I think it's fair at this point, like given how the underwriting works and what the default rates have been, that it's fair for those customers to get those lower rates when they are a stronger deal. And I think the banks still make good money. If you look at the models with an SBA guarantee, good underwriting, and even at prime plus 1.5, they can still do well.
Yeah. We used to be like, hey, there's no collateral here, man. It's It's gonna
Yeah.
be 275,
Yeah.
buddy. No collateral, sorry. But no, it's a lot more competitive. And there's another Lumos chart, shout out Lumos, which I asked him to make,
Mm-hmm.
which was just the pricing over the last 10 years. And there's been
Mm-hmm.
downward pressure to the tune of 50 basis points.
Yeah.
And you just look at the average rates for 10-year paper. Like I tell people, like, well, the average pricing is this prime plus 2 or whatever it is.
Mm-hmm.
So, a lot of shops are built on just like, hey, we want like 10% premium,
Where I get, as a broker now, when I compare across banks, the ones that I kind of am baffled by are the banks or lenders that want that high pricing and high quality.
I
And it's
know.
like, but you can't have in a competitive landscape, you can't ask for A paper and give it C
Doesn't work.
minus pricing. It just
You're going to be
doesn't make
stuck
sense.
at 30, 40, 50 million with 10 BDOs all doing 8.
Right.
It just doesn't work. So you do have to know if you want that type of premium, you have to be able to take on more risk than just about all the other lenders.
Or a different type of risk. The way I look at it is some banks can get really good at understanding a risk that other banks just,
like a perceived risk.
yeah, perceive it much higher than this bank has
Right.
learned it to be.
Like chicken farms.
Chicken farms at Live Oak, or I've got a lender that will do contractors, and they understand work in process.
They know what
and
to look for.
They know what to look for, so their analysis is really sophisticated, and they haven't taken losses the way other banks would have expected. But other banks see those. I see a contractor, forget it,
Right.
I won't do it. And this bank really knows which types of contractors they could lend to safely. So I think it's all about finding little pockets of risk where you can just get good at it.
Exactly.
Yeah.
That makes sense. And the business acquisition is kind of one of those niches in and of itself,
Yes.
because you have to understand that transition risk and all these different things.
Mhm.
And many things go into underwriting a business acquisition successfully. And those people, who really focus on it do tend to be able to get a lot more deals done, where a lot of other banks would just be like, just an absolute no right off the bat, just because of the basics. But once you start digging in, some of these businesses make a lot of sense, and it's fun because you can kind of make it a deal. You know what I mean? Like
Yeah.
there's between structure and
Yeah.
just all sorts of creativity. I feel like any deal that lands on my desk could get done.
Yeah. There's a way.
There's
And
a
if
way.
everyone's flexible, because you've got a buyer and a seller,
Right.
and if the seller's really committed and they want to sell, maybe there's a different, maybe they have to
Yeah.
adjust their offer, and there's another way to get it done. But you're right. I think what you're saying there is in that type of lending, you, the lender, are value add.
Right. Exactly.
You really make a difference
If
in
you're
the
good.
deal if you're good. And so one of the reasons I was attracted to this type of lending is exactly that. I had been, based here in California, in a lot of shops that were very real estate centric. And what I started to realize was that commercial real estate loans, even SBA, owner occupied, they're very commoditized. And, real estate brokers control where the business goes. They send it to 3 banks, and basically it goes to the lowest rate every time, over and over and over. And when you start to see that, you realize that this is just a commoditized space. There's no real winning here. You're kind of on a hamster wheel. I also noticed something just for my own satisfaction in, my work, that lenders didn't care. They didn't appreciate anything you'd done because you hadn't really done anything. You just cookie cuttered it out, got them the lowest rate if you could, and closed the loan. And when it was over, they were just kind of like, oh, thank goodness this is over. That was awful. And so you felt like, what am I really doing?
Yeah. Right.
What am I spending my life doing here?
And
This
it's
is
even
not fun.
It's even worse if you're in the conventional world or whatever.
Mm-hmm.
But yeah, there's only so much you can do on a rent replacement.
No, right, exactly. So you're not really adding value. The customer's not appreciating you. And when I did my first business acquisition deal a long time ago, or it was one of the first ones, the client was great to work with. Every time we asked a question, he was so smart, and he had great answers, and he was flexible with us, and he understood we were on his side trying to get the deal done. And at the end of what was, I think, a pretty difficult process, and looking back now, I think we are able to do it much smoother than we used to. He sent a handwritten thank you note. And all my years of lending and all the, loans I had done, I had never had that happen. And I thought, this is something good is happening here. This is a customer that appreciates what we did. What we did made a difference. And there's got to be more of this. And so that's kind of what got me excited about the space.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show.
That's interesting you say that because I definitely have felt that with a lot of clients, but I also feel like there's like this sort of thing going on where a searcher will, talk to 10 banks or whatever, and almost like I'm being treated like a vendor and a commodity in the decision-making process. Now, if they do go with me and we go, they realize kind of what this all entails and how we are doing all this stuff to kind of clear the way and get the deal done. But in that early on selection process, which your model kind of solves for, but the idea that I'm like lending money, it's like, I don't know, it just feels different now.
I think and I've seen this too. So I do definitely see business buyers who are treating all the bankers that they talk to like a free consultant. And they're not very mindful of the time that they're taking up from those people. They're not really committed to anybody. And they are kind of using people's time in a not very nice way. So where it started out as every borrower that we had was just so appreciative of us. Yes, we have gotten to a space now where it is competitive enough that buyers feel the need, some of them, to kind of, I'd say, overshop and overuse lenders like free consultants. And I think that's unfortunate. I do think that's the minority of buyers still. And yeah, my business model, I think, is designed to solve for that and make it better for both the business buyer, but also the banker. If we can be in the middle of that process, kind of clean things up for the buyer in terms of what do we really have here. Yes, I know you like these bankers, but based on your deal, those banks aren't going to approve your loan. So let's not go to them. Let's not waste any more of their time. Let's figure out what are the 4 or 5 banks that will approve your deal. Go to only those 4 or 5 and get you some term sheets. Then when we go to the 4 or 5 banks, we're doing it in a way that is mindful of their time. So it is, hey, this borrower is under exclusivity with FISO. It's not being shopped to 10 or 20 or whatever lenders. It's being shopped to 4 or 5 that are a match. And it's efficient because the entire data room is put together for you now. It's organized. You have everything you should need to issue a term sheet. So when our lender gets a deal from us, they're reading a very quick email, a 5-minute read to see, yeah, that looks like a deal for us. We've already matched it to their credit box. Then they're going into a data room, totally organized, has every answer to the questions that they're going to ask, has a business and transition plan, has all the tax returns, has everything you're going to need. You can issue a term sheet in 2 or 3 days. And then you're not, even though you're not one of one, you're not the only lender we've gone to, you're one of 4 or 5, at least the amount of time you've put into it is worth a 1 in 4 or 1 in 5 shot at landing the deal.
Can I ask you a silly question?
Yes.
What's the BDO do then?
That is such a good question. Our BDOs they're not doing their traditional role when they're working with us because we have kind of sold the client. We have put the package together. They're basically shepherding it through their own bank process.
It's an expensive shepherd.
It's an expensive shepherd, and don't think we haven't thought about that too. In the long run, probably it's not necessary. We really probably need an inside salesperson shepherd kind of at the end of the day. But we go with what the current model in banks is, right? We're not asking banks to change for us. We're just bringing them customers in a very efficient way, and then we kind of take it from there.
Going back to what I was saying earlier, complaining like an old grumpy person about, buyers and stuff. It's not so much that they're like I'm probably, too willing to give my time. Like I return all calls, emails, all this stuff. I get on calls. Have you noticed like borrowers like they read the SOP
Mm.
and they want to like challenge you on your interpretation of the SOP? This is not something we dealt with 10 years ago.
Yeah, now I think AI has just made that so much easier too, because now they can just drop it into ChatGPT and query it. And of course, ChatGPT is kind of wrong in their interpretations depending on how you prompt it. Yeah, we
I've
get
seen it be
people that
wrong.
argue. We are in a unique position though, because as we're not a bank, and we understand that out of our network of banks, some of them are going to see it differently in some of the gray areas of the SOP. So that's how we kind of talk to our clients is, these are the gray areas, and some banks are going to interpret those areas differently. There are some black and white areas that I think we all agree on, but there are some gray areas where some banks just are going to see it differently.
Well, and also it's the minimum set of rules. And so every
Yeah,
lender adds their own criterias on
to
top of
that.
it.
Yes.
And now we're in an interesting situation where we do deal with borrowers who know the SOP more than some of my colleagues in the
Mm-hmm.
industry.
Yeah.
And it's like, it's fine, but I've got to explain like, yeah, I get that. But like we're lending the money, so we do want, what we asked for.
Yeah. Right. That's buyer education. Is just kind
Right.
of letting
It's
them know this is
education.
not a mortgage. This is not just a set of rigid rules that have to be followed. This is everyone's interpretation of the rules and then their credit box and their credit preferences on top of that. I love being a broker in this space because I love being,
You
able
get to be
to.
the nice girl now. I'm
Yeah,
the
I
bad
don't
guy.
have to give the bad, like my credit guy thinks it's this way and that's that. It can be like, well, there's 5 banks and they're all seeing it slightly differently. And, let's decide what's going to be most important to
Yeah.
you.
No, you've got it figured out. I love your model. I love what you're doing. I want to get into why you're doing it and all like that and how it's been going. So your last within the institution, your last one was at Live Oak. Everyone knows that, so we can just
hmm
say that.
hmm
Um you left. You don't have to explain why you left. I mean, I know why you left. I mean, who wouldn't? You're crushing it. And probably, crushing it on many fronts. Talk to me about the vision you had when you were kind of starting this brokerage.
So the vision I had was that because there's a lot of gray area and because this is a very complex type of loan, a business acquisition loan specifically, not just SBA and all the rules and regulations, but throwing that into the business acquisition context, it's very challenging. And it's the kind of loan that people could use help,
Absolutely.
with. The clients can use help, even the banks can use help. I think because I sort of pioneered this kind of loan in the year that I went to Live Oak in 2017, I felt I could help my clients better with a lot of banks to choose from. And I also thought I could help some of the banks understand it better, how to approach certain elements of it, how to look at things, how to analyze things, how to communicate about it internally. Things like that are kind of complicated, like the working capital component, things like that. So I felt I had a lot to offer to both sides, the buyers and the banks. And I wasn't going to be able to offer it to anybody if I'm only representing one bank. And I do think that the decision that we made early on, which was not to develop business from brokers, but to reach the buyers directly, allowed me the freedom to leave the bank and have, start Visa
Exactly.
Business Capital.
Exactly. Because my next question was going to be like, is this a trend we're going to see within BDOs wanting to
hmm
be like Heather?
Yeah. I don't see why not. I mean, it actually, I thought I would see more by now already, to be honest. But I guess it depends on how you develop your business.
Right. I think they are largely driven by referral fee
Yeah.
paid partners.
Right.
That's probably the biggest thing holding them back. But a lot of us have now online personas and personal
hmm
branding,
Yeah.
which is now getting us that more direct interactions with borrowers. And then that I think is going to set us up for that transition.
I think people care more about the personal brand of who they're working with than they do the bank brand. I know
100%.
that in what I do every day. They don't, when they get the term sheets, they want me to help them make that decision. And it doesn't matter whether it's Live Oak or Byline or, it matters who at that bank we're working with and how comfortable they felt about the process with that person so far. So it's all
Yeah.
personal branding is everything.
So critical. I mean, I've seen it firsthand from when because I kind of grew up at Ready Capital and I was there for 6 years and then I jumped. And that was my first time jumping. And I jumped to Fundex and it was my first time jumping after being established. So I honestly didn't know if any referral sources were going to want to do business with me.
It's scary.
And then they started saying things like, just tell wherever you go, we're with you. Like, we just want to do business with you. And then I was like, oh, wow.
And then the light goes on and you realize, yep.
Yeah. So it's like, that's why the brokerage model sounds so, it makes so much sense in our space because virtually all of the BDOs that are out here developing business out in the wild are doing it based on ourselves.
Yeah.
The fact that we're picking up our phones.
Yep.
We're solving problems. We're just vibing good with the clients. That's all they care about.
Right.
And so, but they're stuck with just one credit box. So that's the problem. So you have access to how many, like 30 different banks? Basically?
And I mean, we can keep expanding that if we
All
want
of them,
or need to. Yeah,
eventually.
we add banks all the time that sometimes they're reaching out to us. Sometimes our clients are introducing us to a bank saying, you know, I've gotten to know this bank over here and we want to work with Viso, but could you please also include this banker? And that's our first introduction to that bank. And sometimes it turns into a really great relationship for us going forward.
And that bank then pays you, even though
they may have known the client.
which to some people it might not make sense, but to some people it does, in the sense that like matching borrower and bank to me is like 5% of the job. Like anyone could do that. You know, you could. That's easy. It's the value add stuff that is what you're getting paid for.
Right. And I mean, it's let's dive into what that is sometimes. Like I mentioned, working capital. I think there are a lot of banks out there doing these business acquisition loans that don't understand working capital correctly. And part of what we sell our clients on is we know how to do it. We know how to explain it. And we will keep you with those banks that get it, especially if you have a more challenging working capital situation. So we're going to go to the banks that understand what we're talking about and are willing to structure the loan properly for you. Example, sometimes the seller won't sell you working capital. And you still agree to buy it without, but you've got to assess how much am I going to need and where should it come from. A lot of banks will stick you with a line of credit. And I say that's not the right way to do it, because that is going to be an evergreen line of credit you'll never be able to pay down or pay off, and you'll be strapped. Instead, you've got to have it in the term loan. But there are credit folks out there today who will say, but you're putting in $200,000 of equity and I'm giving you back $200,000 of working capital. And that is not the proper way to look at it, because that $200,000 could have easily been in the purchase price. It's just that the seller wouldn't agree to that. So it's just moving that from the purchase price down to the working capital.
Yeah.
And there are credit people out there who think they're doing a good job by denying working capital, but they're actually creating a ton of risk for the buyer and their bank because they don't understand it.
Oh, absolutely.
And those are the little things that we do to make sure that we're adding value to the client's experience and to the banks that we work with, that we're making sure we're not getting our clients or our banks into those kinds of situations.
I feel bad for whoever did business with me in like 2012, 2013, when I was like 1 and 2
when
years
you were learning.
My bank was like basically working capital, 5% of the project, let's say, or like, or just none, to limit our exposure, or just
and
all
they
these
thought they were doing a better job of risk, and it was
risk-based
terrible.
decisions. Yeah. But it was arbitrary stuff. I mean, there's obviously a science to figuring out adequate working capital. If you don't figure that out, I mean, you're setting yourself up for failure.
Yeah. A lot of buyers in this space don't understand it either. So I mean, they can easily take a loan and think they're trusting the bank on that portion and find out, you know, or too late.
Yeah. A lot of, and I mean, we could just do 15 minutes, get the slideshows out, and we can teach working capital to the industry.
We could just do that.
Maybe next episode. Maybe, unless you want to tell us anything about preferred equity, but I don't think anyone.
Preferred equity.
I don't know that anyone
talk about it.
No one has answers to that, right? I mean,
well, I saw some emails from the SBA questions box this week.
Okay.
That were not the answers I was hoping that would have come out from that.
Are we gonna break some news here? This is gonna probably come out late. But.
Well, so if you read the language that they put out in the SOP, it seems to say, I won't be able to say it exactly verbatim, but it seemed to say any kind of equity or preferred equity structure that looks like debt,
Yeah.
we're going to treat it like debt. But they didn't go into what does that mean. And so those of us who work a lot with preferred equity structures kind of thought, well, like the reasonable explanation to what that means is if there are no mandatory distributions, they're just simply discretionary distributions or tax distributions, because the investors need to be, get a distribution, pay the taxes if the company is doing well. We just kind of thought if they're discretionary and they're tax distributions, though, that's not debt. That wouldn't be looked at like debt. So
that's where I was too.
So that would be okay.
You want to take a distribution. Who cares if it goes to this guy or that guy?
Or if you've just got so much excess cash built up because the company's doing well.
Exactly. If you're taking distributions, it's a good thing. So if it's not required, you're just saying, hey, I'm going to do this. You're probably in good shape at that point. So I'm with you.
Right. And we even thought, well, maybe what you should do then is get permission from the bank before you do the distribution. That can't hurt. And, maybe if you did that and they're discretionary and they're just for taxes, you should be fine. So I saw an exchange with 7A questions.
Here it goes.
And it went back and forth like 3 times clarifying, wait, what about tax distributions? What about if they're totally discretionary? And the answer came back every time that if there were any distributions made while the SBA loan is still outstanding, that is the situation where it would be considered as debt, not equity.
I choose to not believe that.
I know. I agree with you. I was like, I feel like whoever this person is, I need to reach this person and talk to them about it.
No,
because I don't think they understand.
Makes no sense.
And I also think the idea, it sure felt like the SBA came out and said having equity investors with SBA loans is bad for businesses. It feels like that's what they're afraid that it's bad for small businesses. And I think those of us who have been really close to this part of the space don't agree with that. It's never bad to have more access to capital for small companies in this country. It is never bad to have people willing to put equity into small companies. I shouldn't say never. Yes, equity terms could get so onerous that they are bad. They are always below debt in the cap stack, so they're not. I don't think bad equity terms are creating defaults. Why would they? Because if you're, if you're investing in a company, why would you create a loan default and kill the company? So
I'm just trying to take the other side for the sake of this conversation.
For the argument.
So let me try. Let me harness.
All right, let's do it. Let's fight.
Okay, if you need an investor to come up with your 10% down, then maybe you shouldn't be doing this.
All right. I would say if you need the whole 10%, you have none of your own money, you're probably right. I would agree with that. But let's take the other type of person who either doesn't have enough equity or does, but would like some really great people to be owning the business with them because they're going to help them. So these are what I call value add investors. I think there's a big difference between a friends and family investor who's doesn't have any experience to bring to the table or any engagement to bring to the table. That's different. Let's talk about just value add investors for a second. If I'm going to buy a business and I've got some folks that I know who have more industry experience or a really great network that I want to tap into when I buy this business, I want them to have ownership with me so that they have some reason to help me tap into their network or help me make decisions or whatever. If they're going to be engaged and they are value add because they have experience, then they are going to not increase my risk on that investment. I'm bringing them in because they are going to decrease my risk in that owning that business. They're going to help me.
And I don't think anyone would take issue with that because you can do that and not have a preferred equity. I think it's the traditional investor market that's kind of been created for these deals that is wanting the preferred equity structure, and they are looking at it from more of a financial play.
You've got both types. I mean, I definitely know people who are very wealthy who make investments in this space that they don't need that investment to pay off at all. They do it because they love the mentorship. They love helping people run small companies. They just love it. So I think anything that kind of scares them away is a bad idea. We want them involved and doing what they've been doing all these years. If they could have preferred equity without mandatory distributions and just tax distributions and potentially some discretionary distributions, but maybe none, if there's not enough cash ever to make any, they would still be investing. I think they won't be scared away from that. But if you tell them you've got to make a 10-year investment, no matter how this guy hits it out of the park, if he's got the debt owing, you can't get a penny out. I mean, I think that's a little too far, and it's not necessarily in the best interest of anybody.
And it just makes no sense. And it's like they called out the search funding stuff, and it's like, why are we doing this? And it's not even like we can't do it anymore. It's just like added a lot of different rules that no one's been able to give the sort of why behind that make it harder to do it, almost like they're trying to kill it without directly killing it. So you have like sellers need to guarantee the loan for 2 years on a partial change of ownership.
Yeah.
Okay. I wouldn't do that if I was a seller. You do see it happening, out there. Surprisingly, some people are doing it. But that right there is like, okay, that is a tough sell. I think I would want you can make the case that you would want the seller to have an equity stake as the business is being transitioned. I mean, if, we either think that mitigates risk or we don't, but like adding this PG requirement kind of muddies water, but that's just the starting point. The idea that a 1% owner on a partial also needs to be a co-borrower and pledge all their real estate as collateral. Now that one really makes no sense. And then now they're coming at, I guess, preferred equity or whatever. So they're trying to like dismantle it in a way. Why is that? I mean,
yeah, where did this come from? I think of them as two different things. The rollover equity thing, I honestly couldn't tell you what the reasoning behind making all three of those conditions. If I'm selling something to someone, I'm not personally guaranteeing the loan that they use. I'm selling
Makes
it or
no
I'm not
sense.
selling it. The one thing I'll say about that piece, it really mainly affected sellers who have licenses.
Right.
And buyer, there's not enough, there's not any master plumbers out there looking to buy businesses, right? So if you have that kind of business, you have nobody to sell it to. So to me, that there's an easy fix for that one. Let the lender use their own discretion about the seller staying on more than 12 months. We don't need sellers to leave in 12 months. A lot of times we're actually
Right.
creating risk.
Right.
And
Why
that
would
rule's
we-
been around forever.
I just accept that as the rule
But
without sometimes I forget to
outside
even
of
question
SBA, that doesn't exist.
Why would that be a rule?
Right. If you're not using SBA money and you were buying a master plumber business or business that requires that license and you needed him to stick around, you'd put some kind of agreement together. He doesn't have to roll over equity to do that or personally guarantee your loan. You're not going to kick the person out that has the experience in the license before the new buyer can get theirs just because 12 months is 12 months. I mean, I feel like that's an easy fix. We could change that.
There's a lot of easy fixes, I feel like. Like, for example, if you have a buyer doing a partial change of ownership that is qualified, has a good financial statement, and has experience, and the seller wants to retain 5%, and continue working there as a sales rep,
Yeah.
why do you need the seller to guarantee? Because that deal, you do it as a complete change of ownership, and you've got all the pieces in places. You've got all the 5 C's of credit covered.
It
Like, why do
doesn't
we need
make
this
sense.
additional enhancement?
Well, I'll go one step further. I'm not a lawyer, but if somebody closes a deal like that where the seller has to give that PG for 2 years and the deal defaults in the first 2 years, somewhere in that time frame, and the SBA says, okay, we're coming after all the PGs, including yours, I have a feeling that there's a defense for that seller's PG to say, I didn't control the business after I sold it. They just made me, sign this. I wasn't even in control. I only owned 1%.
Yeah.
And I wasn't doing anything other than holding the license. And they sort of made me do this. I shouldn't have had to PG. I had no, I didn't have enough interest in the business. I feel like there's a defense there because I just don't think that it makes a lot of sense.
Yeah. Oh man, interesting times. I would say also on a partial, so the one argument could be like, well, on a partial, if the balance sheet has 9-to-1 debt to equity, you don't need an injection. So the skin in the game is the seller's guarantee in a way, because it's their business, they're guaranteeing. So, but I would much rather get rid of the seller PG and just add a requirement that every buyer needs to put in some injection on a partial change of ownership. Like, no one ever was asking to do a partial change of ownership with no equity injection.
I honestly felt the only actual use case for the partial change of ownership was to get around the 12-month rule for the licenses. And if that's all, if that's 90% of what people were using it for, it's so much easier. Let's just do away with the 12-month rule, or let the lender do away with it when they use proper discretion. It doesn't have to be for everybody, but it has to be maybe just for those license situations that they're under certain conditions. The seller's license can be used for longer than 12 months.
Exactly.
Would fix it.
Okay. All right. We beat that dead horse.
Yeah.
Can we talk about the government is watching you now?
Okay. Hi.
It should actually help you, I feel like, because if Congress does force SBA to give them all that 159 data,
hmm
I mean, obviously you're not like the way you're approaching this, you'd be like the last one to be like, oh yeah, this fraud and
I think it could help me.
craziness.
Yeah, I think it
Like,
could
but
help me.
there are bad actors out there.
hmm
And so, yeah, let's all get rid of the fraud. We all agree there. And
Yeah.
then if there are some brokers where they're just like funneling deals and they just have abnormally high defaults, and we look under the hood, maybe there is some fraud there, but it's still kind of creepy just to know that you're like now having to be watched. Cause like we, as a BDO, you don't have to deal with that,
Right.
But-
There's no record of every deal
Yeah.
you've ever done. What's interesting is that 159 is also signed by business brokers who get the fee.
Right.
So if there's, to me, what I see every day, if there's actual fraud, it tends to be there because, again, they're getting a big commission selling the business if they get this loan through. And like you said, sometimes they're answering questions for the bank blatantly wrong because they're trying to get their deal closed. So I think that's kind of an interesting angle on
Yeah,
it.
we'll
Are
see
there
where that
some
goes.
business brokers who've been paid a lot by banks and have a lot of those deals, gone into default? And could you look back at the Q&A and some of the things that were done?
That'll be interesting. Yeah.
Right? Yeah. So I feel like I monitor my own portfolio, so to speak. It's not my portfolio, but I track every one of the clients that we've closed, and I survey them and I ask them if there's anything we missed or we could have done better in underwriting. I love to learn from the process. And I think that, how do I make my value add better and better every deal, every month, every year?
Right.
It's learning. And so, yeah, I'm all about knowing the data. That's why I like Lumos so much and use their charts all the time. I want to know how everyone's doing, and where there were failures, what could we have done differently? How could we have spotted that
yeah.
sooner?
I like that too. Actually, I'm looking into, anything that becomes a problem after it's closed. I'm like looking into all of that and seeing what happened.
And develop your own opinion about, if we had done this or we had asked that question, perhaps we wouldn't have made this loan this way.
Because if I don't do it, someone's going to look at it and be like, oh yeah, it was a car wash. Now we don't do car washes anymore.
Right. They're exactly the people who are not intimately involved in the deal, when they decide what caused the default, it's not usually right.
They go to the lowest common denominator.
Yeah, it's not, and it's better for the people who were involved to go back and look at the deals that went bad and really look hard at everything and decide what really caused this and how can we prevent it in the future.
If you could change one thing about SBA lending, what would it be?
Oh my gosh. If I could change one
Could be a policy thing.
Yeah, I would go with that. I wish there were, I know we have Nagel, and Nagel's, there to represent the interests of the lenders, but sorry, Nagel, but over the years, it feels like they became very bureaucratic too. And I would love a cleaner line of communication to the SBA about policies. Like, I think we wouldn't have ended up with some of the recent changes that we just got if there were better understanding from people who are on the front lines with the customers to the SBA policymakers. I think there's too much static in between, whether it's Nagel or administrators in the bank kind of doing their own interpretations. I think people like you and people like me and other people who are talking to the direct customers every day about what this is like, I think we need a voice that gets through to the policymakers to help them. That would be the one thing I would change, is to get rid of all that middle static and let the SBA hear more directly.
I think that's a good sort of opportunity for the board, which as of today I am running for, has to bring to Nagel, be like, hey, now I don't know how many of them are actually still doing deals, but like I think people close to the deals should be on the board versus tends to be a lot of people who are
administrative people.
Exactly. So that'll be a nice.
Which I used to be one. So I can say, I know that when I was a manager of the department, I did not know as well what was going on with my customers and what they really needed than I do today, by far. because it was filtered through too many people who had different reasons for telling me things were a certain way. But today, and for the last, 8 years that I've been directly working with clients, and it's part of why I do what I do. I like that. I like knowing actually what they need and what they like and what they don't like without any filters. So I know that, yes, if the board of Nagel or somehow the SBA had more contact with people that talk to the customers every day, they would have a clearer understanding of what's going on.
And I think I think they have a good understanding of a lot of these things, but it's like there's so many things and you have to like prioritize them and you're dealing with the government. And I think sometimes my priorities are different than their priorities,
Sure.
are different than the SBA's priorities, and it's
Yeah.
different than the SBA priorities. So that gets frustrating. But doing a partial change of ownership and all that, it's like it's a privilege to be able to do that, that we didn't even have for the first
That's
70
true.
years of the program. So I got to put it into context. Meanwhile, like their E-Tran's broken. So they got to fix
Right.
E-Tran.
Right. It's like any big organization, right? Not to criticize, but just to say, I think understanding directly how their customers are doing things and what they need and what small businesses need, I think could make the whole policy making exercise a lot more efficient and effective.
Yeah.
We end up with policies that end up with low default rates, but also getting capital out the door where it needs to go.
Well, we were talking about this earlier with Diane, but like, do you remember they used to put out like, here's what we're thinking about doing for the next 60 days. Go ahead and give us your feedback. And
Yeah.
then a month later, they come back and they say, hey, this is going to affect in 60 days.
Yeah.
And now it's like, it's 3 a.m. Let's drop a notice.
Yeah, I think there
effective.
was an urgency, and I understand that. There was an urgency to, have an impact and take care of things that they felt needed to be taken care of.
Yeah.
But I do think there were a lot of people who didn't understand what a search fund was, telling SBA what was happening with search funds.
Yeah.
And the people who actually know what search funds are doing and what's common and what's, what might help. And, they weren't.
Did they not call you?
No, they did not call me.
So strange.
They did not. And in fact, I did reach out even to Nagel to offer, to talk and educate, and that was not received.
Yeah.
So
Got lost in the mail, I guess.
yeah.
BDOs live such a glamorous lifestyle, or so it seems. And what I'm noticing is a lot of underwriters, closers, BDAs have decided they want to be BDOs.
Oh,
So
yeah.
I'm curious, what advice would you have for them?
Well, I mean, everybody should pursue what they want to pursue and go for it. First of all, don't be afraid. Just because whatever position you started at, or, don't hold back. You can do anything you want to do. Just understand what it is, what the job is, and have a strategy. In any sales, whether it's SBA sales or anything else, you're not going to be successful without a strategy. So you've got to really think it through. What is going to be your strategy? How are you going to go block and tackle to achieve that strategy? And I think once you achieve a little bit of traction and success, let's say you get a good following in a certain space that you wanted to pursue, if your bank suddenly decides, and this happens all the time, to switch gears and say, well, we're not doing that anymore, and you're having some success there, maybe instead of changing with the bank, maybe you should change banks and find, stick with your strategy. Because strategies, like in sales, strategies take a long time. It's compounding. You've got to be doing it for years in order to get really good at something. So I think the mistake young folks make when they're early, or just early in their career or early in their sales career, is letting the bank pull the plug on their strategy instead of saying, well, maybe there's another bank that will like this strategy and I can keep it going.
A bit of a hot take. I like it. Last question.
Mhm.
How's working with your daughter?
Oh, I love it. Yeah, it's one of the benefits. I mean, there's so many benefits of being my own company now and not being part of a big organization, all the politics and all the stuff I don't have to deal with. But a lot of other silver linings, like being able to work with my daughter and teach her, how everything works. And now we have the same network. She knows all the lenders and she knows the
Yes.
clients. And
I know her.
and you know her. Exactly. And so I also feel like at this stage of my career, had I finished out my career at a bank, I would be passing off my contacts to somebody I don't really know, and here you go, young lender, you're getting all my contacts. Instead, when it is time for me to retire, which I'm not ready at all, but it'll be passing it on to my daughter, which
That's
is so much
amazing.
better. Yeah.
Amazing. Well, Heather, thank you so much for coming up
Thank
here
you
and
for
doing
having
this
me.
today.
I
This was
appreciate it.
wonderful. Long overdue.
Yeah. Thank you so much.
All right.
All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.